context, I think this rally, at least a 3-day rally, which is encouraging, has given investors a temptation to try to call a bottom. And I would urge people to not do that yet. I think bottoming is going to be a process here. We maybe have begun the process of bottoming, and it's nice to see the market react positively to a fiscal package and monetary stimulus, because it was sort of dismissive of Fed stimulus in prior weeks. But I think we're still going to bounce around here for a while. And a little bit of a pullback today, not something that should be unexpected.
So, Josh Brown, where does this leave us? You know, there are what seems to be a growing number of bottom calls or close to a bottom calls, right? We heard from Lee Cooperman today, who was on Squawk Box. I'll find it in my notes, which are scribbled all over at this point. But what do you think about that?
I would love to be wrong about this, but I was very clear on Tuesday. I do not think the market can bottom until the virus tops. And so I really think we need to see the rate of infections slow and then decelerate in places like Italy and New York City before we should look at any market action and say, okay, yes, that was the low. It's now safe to feel as though it's all upside from here. I'm sorry. I can't get there mentally. I could end up being wrong. But New York State had 7,377 new cases reported as of this morning. Many of them are in Manhattan. And I just don't think that's the fertile ground in max pain on the headline front that we need for stocks. But let me tell you what I think the last 3 days did accomplish. First things first, liquidity has returned to the fixed income market, at least on the ETF side. All of these ETFs that we were looking at as being a quote-unquote problem have had V-shaped recoveries, and I think that's good. We've also worked off some very oversold conditions. Zero stocks are now at a 10-day low. That number was north of 95 a week and a half ago. Most importantly, though, even with this incredible world record-setting bounce that we've just seen over the last 3 days, you still, Scott, have only 2.8% of S&P 500 stocks above their 50 days. 50 days. So almost nothing is in anything that you would consider to be an uptrend, despite the fact that we've had this 21% trough to peak bounce. So I'm going to tell you to look at high beta, getting absolutely thrashed today. The SPHB is the way to look at that. It's an ETF. It's down almost 5%. Meanwhile, S&P low volatility, SPLV is the ETF for that, is off only 1.4%. And your crisis basket is still working. Zoom, Slack, Teladoc, all three are names that I've owned for months and months. So when you look at those internals, you look at what's working versus what isn't, and then you look at the infection count continuing to grow, very, very hard for me to say we're not going to see under 20,000 again in the Dow.
Yeah, it's obviously a fair assessment. You're not the only one making it. Steve Weiss, you know, to Josh's point, history suggests that you're going to get a retest. It doesn't happen every single time, but the majority of times that you've had this level of thunderous decline and then as thunderous of snapback, you often do get a retest at or near the lows.
And I would expect that. So I agree. I think where there may be a difference, or maybe not, but what Josh didn't express, which I will, is that it's quaint to say at this point, right, but you can't pick bottoms, you can't pick tops. But if you're sitting with cash, and I was sitting with an enormous amount of cash, you have to pick a point where you're comfortable going in. Now, I've been saying this week that I quantify my risk as the lows that we saw on Monday. Maybe we go a couple percentage lower. I don't know. But at this point, I think that the market will discount, as it always does, events before they happen, including a peak in the cases and the deaths that we see not only in New York but in the rest of the country. I don't know when that discounting mechanism will take hold. So I bought companies that I felt comfortable with. I still have cash. That if they go down to that level, I anticipate that. But investing is a risk reward. The most important part is quantifying your risk, knowing that you can't do it with absolute certainty. So could the market be down, and I was looking for 30% decline or so? Could it be down 35%? Sure. Could it be down 40%? Frankly, it wouldn't surprise me. But the risk we see is that it moves up quicker. Now, today is the most rational day, in my view, of the week. Yesterday was irrational at the end. We had on Wednesday a big move. Tuesday was incredible. Monday was the other. Today is more rational, giving up the gains of 20% that we had over 3 days. So it continues to be a market of discomfort because of the huge volatility, huge swings. But I still, at some point, need to be putting money to work.